Yeah. So here we go one more time. I said we have an accounting equation, which is asset equals to liability plus equity. This is an accounting equation came up with an Italian merchant, Rico Pacioli, father of accounting, about 500 years ago. So we're still using the same thing. The equity part of a business might be few pieces. This is the owner's capital. This is the capital has been raised to increase the equity of a capital of a business by owner's investment if it's a sole proprietorship, okay? If it's a corporation, it becomes common stock. But if it's a sole proprietorship, it's owner's capital. So here in this class, the emphasis is on sole proprietorship, but I am teaching both sole proprietorship and corporation in the same time. So hopefully that will be better. And okay, owner's capital, but the equity goes down if the owner withdraw from the account. So if the owner withdraw from the checking account for personal reasons, that will be a negative impact. Plus revenue, plus minus expense. So in order to increase equity, there's two ways to increase equity. Either you use outside source, like capital from owners or owner or shareholders, or inside source, which is revenue minus income. Revenue minus income by itself is what? Revenue minus income, what is it? Net income. So revenue minus income means net income. That's what it means. Okay? Revenue minus income means net income. Now, account numbers. Every account starts with a number. So asset starts with 1. Liability always starts with 2. In our class, we're going to use 3-digit, but in a real life, you use 5, 6-digit. Okay? Equity, owner's capital starts with 3, withdrawal starts with 3, revenue starts with 5. In regards to expenses, it starts with 5 and 6. 5 for cost of goods sold and 6 for expenses, regular expenses. And we have yeah, revenue minus expense will become net income. Exactly. Yes, that was in the chat box. Okay. So day 1, this is what happened. Day 1, this owner of this company opened his business for starting January 1st. And initial first deposit into the business checking was $100,000 by the owner, and we need to journalize it. In order to journalize it, whatever you need to put in this equation needs to be done twice. Otherwise, you will break the equation. Make sense? So doing twice, we call it debit and credit. Debit or credit doesn't mean anything at all. But here, debit and credit is just a simple name. You could have say left side, right side, but instead of saying left side, right side, it's not professional. So we call it debit or credit. Means nothing, it's just a name, okay? So we do it twice in order to keep this equation balanced. So now the problem is, gosh, which one needs to be debited? Which one needs to be credited? First of all, what did you get? You get cash, right? So you start with cash, which is you received it. And the first line, we always do debit, and all credits will be last. Debits first, credit last. Okay, so debits. Cash, why should be debit? There is no clear answer for it. But as I explained last time, I came up with a story. It should be like funny and stupid story, but still it works, doesn't matter. All you need to do is just make sure don't tell anyone, because you look bad, I look bad. But it works, who cares? So here we go. Standing here, right next to cash, do you see me? You don't see me, but I'm just saying. So I'm standing here next to cash. Someone gives me $100,000. Where do I put it? Obviously, if someone gives me $100,000, honestly, at this moment, I will put it in my pocket immediately. Why? Because I don't want anyone see it. They will literally kill you for $100,000 in the middle of street daylight. So what do you put it? You put it in your pocket. So from here that I'm standing, the reason you put it in your pocket because it's close to you, right? It's the safest place. So where I'm standing next to cash, the closest place is debit. Do you see that? Closest place is debit. That's why I put it in under debit. So if that one, which is an asset, any asset, building, equipment, machinery, accounts receivable, inventory, supplies, cash, whatever, any asset. If you receive it, put it in your pocket, close to you. Simple like that. Make sense? Can you remember that? Common sense, right? So if that is a debit, the other one is a credit no matter what it is, okay? So this one is debit, swear to God, 100%, put it in your pocket, close to you. The other one has no other option, has to be credit. And the other one goes here, 100,000, you need a name. So why did you get 100,000? Did you borrow? No. What did you do? Oh, that was owner's initial deposit into business, owner's investment, so you call it owner's capital. Cool? And that will be credit $100,000. One more time, what is asset? Asset is something that gives you future benefit, right? Like you have a building, it provides you future benefit. You have cash, it provides you future benefit. You have accounts receivable, it's providing future benefit, right? Asset is something that provides you future benefit. Like I have a degree, my degree is my asset. Make sense? I have a car, my car is my asset. I have a home, home is my asset. And a liability is something that you owe, right? For example, I give you an example so you can easily understand what's going on. Imagine I buy a home. So I buy this home for $100,000. I put $30,000 as a down payment and I borrow $70,000 from a bank, like a mortgage. So how much is my equity at this moment? My equity at this moment, look at this accounting equation. My asset is 100,000, my liability is 70,000, my equity is 30,000. Make sense? 100,000 asset, here, asset. Liability will be 70,000, and my equity will be 30,000. Okay, 1 year forward, my house now worth, let's say, $120,000 in the free market, right? So in that case, if someone asks me how much asset do you have, I will say, let's say my asset is $120,000, my home. And they say, how much do you owe on your home? Let's say after 1 year, I owe still 70,000, so I will say it's 70. And then they say, well, how much is your equity? So 120 minus 70, so my equity increased to $50,000. Right? So your equity is increasing. Why? Because your house market value increased. So bottom line, so when you have a cash, that's a future benefit, okay? And the equity section, which owner's capital is a portion of that, is the initial investment by the owner into the business on day one. That's $100,000 credit. And then you click somewhere here, let's say. And if it's a QuickBooks, you click here, which says save and new, or save and close. Save and close, that means that's the only journal entry you want to do. Save and new means I want to do this one, save it, plus I want to do another one. So there's a box here says date in the QuickBooks. You click date, whatever the date is for today. And then debit, there's a box in here, you see where the cross is, there's a box there. I click on that box, chart of account, drop down menu will open. I choose cash and then move on to here. I type 100,000. Then automatically 100,000, I believe, will pop up in here. Only I need to do is just go to here. You see where the cross is? Click one more time right there. And the drop down menu of chart of account will open. And I choose owner's capital, click on that. And then save and new or save and close, whichever you want. So you click save. That means in accounting, we call it post it. So you post it to where? You post it in somewhere that you call it general ledger here. This is third page if you made a copy paper, okay? If you printed the document I gave you. So this is the general ledger, write it down if you are using a paper. And then cash, the first account, you create that. You create with an account number, let's say 110. And your $100,000 will pop up in here. As you see, I used a formula, okay? I don't type anything. I just copy it from the source document, which is at the top. And the owner's capital, same thing, needs an account number. And the account will also come from formula from the top. And that's where it's coming from. So no typing, okay? And if you want to see the accounting equation in general to see how it works, this is how it works. So I have $100,000 on the asset part. I have $100,000 on the owner's capital section. So some way, somehow, as you see, my balance is, both sides is balanced. I'm not missing anything. Cool? Any questions so far? So here I'm just going to show you the sum. You see how I did it? Enter. The sum will be here. And I want to see all these numbers in dollars. So I go here and I say I want dollars. But I don't want the decimal. So here we go. Okay. Okay, now watch. You see, I want to do the same thing over here. So the formula here came from addition of all these numbers. So I'm going to grab that fill handle. You see that fill handle on the corner? And I'm going to pull it to the right, let it go. And here we go. Now, all of a sudden, all these boxes, they have a formula, which asset, whatever it is in here, should be equal to the liabilities and equities on both sides. As you see, it is equal. Questions, please? Okay. So let's do another one. And looks like we purchased equipment.
Hey, Professor.
Yes.
I just had a question, like, no, that might be not good. I don't know. There is cash if somebody given to us, that's owner's capital. Do we need to pay this back, or this will be our, what you call, our assets?
This
cash given by somebody. Is that loan, or is that just given to me by somebody? Just assume I got that money from somebody for free. So that might be my asset, or that is I need to pay back.
Okay, listen, first of all, $100,000 came into business. Agree on that, yes or no? You might borrow that money. You might bring it from your own personal pocket into business. So if you borrow that, let's say here, if you borrow, let's say from here, your owner's capital is only 40,000, right? And here you brought $60,000 by form of borrowing from a friend or from an organization or from a bank or whatever. So here, that would be note payable. Make sense? So in this case, your company has asset of 100,000, but you have 40,000. No, sorry. You have $60,000 borrowing. You see that? And your owner's capital is only 40. Still is equal on both sides.
Okay.
But $60,000 is a liability.
Okay.
But $40,000 is from your own pocket into the business day one.
Okay, thank you.
Sure. Good question. Okay, but for now, this is not the situation. So I could have made it like this, but it might be a little bit more confusing for day one. So I try to keep it as simple as possible for now. So this would be equals to that box, enter, and this will be delete. There you go. Okay, so the second one, it says you purchased equipment for $13,000. Residual value is $1,000 with 10 years life. Residual value means salvage value. And that means you can sell this equipment maybe about 10 years from now in about $1,000. Those are all estimate, okay? 10 years is estimate, $1,000 is estimate. But you need to know those in order to do your depreciation later on. However, the equipment, you purchased it for today, $13,000. It doesn't say you borrow anything. So since there is no borrowing discussion here, so that means we paid for it, okay? Again, just to keep it simple. So here we go. What did you get? You bought equipment. Equipment is an asset, agree? So when you get an asset, where do you put it? In your pocket, close to you, right? So here we go. Equipment is an asset. If anytime I get an equipment, I put it in my pocket, close to me, for $13,000. Cool? Do I type this? No. So what do I say then? I say equals to that box, enter. Cool? So $13,000 goes there. Here is a dollar sign, but you in a QuickBooks, you don't need to put a dollar sign. QuickBooks knows it's a dollar sign. Doesn't matter. For us, right now, we are just practicing. So here, this box equals to that equipment that we purchased, which is $13,000. But did we pay for it, right? So it's a cash. So let's do some indent. For credit, we do indent, okay? In accounting classroom, we do indent. In QuickBooks, you don't do indent or anything. But for QuickBooks, I mean for classroom environment, we show indent to show that this line is a credit line. So it's a credit, $13,000. If I like to show you in here, this is what happened. So this is equals to the equipment that we purchased, okay? And this one equals to minus that cash that has been decreased. So there you go. As you see, still my assets equals to liability plus equity, there's no changes in that. But it is a double entry, and that's the double entry effect that you see in here. And then you click here, say save, so-called, and you go and save it manually because this is not a QuickBooks. So we say cash has been credited, so equals to cash, that works, enter. And then I need equipment, so here you go, say equipment, which is account number what? Let's go to let's go to worksheet and look at the equipment. Account number is 167. Why is 167? Why is not 127, let's say, huh? Because 127, it's way up there. At the top, you don't have heavy, non-liquid fixed asset. Fixed assets are less liquid. Fixed assets are less liquid, so they will be at the bottom of the account numbers, okay? Let's say accounts receivable, cash, supplies, those, they can be so-called 110, 115, 120, 130, but equipment, you make it 170, 180, 190, something at the lower section of numbers. Okay, so 167, let's go back. So account number for equipment, we call it 167. Enter. So equipment is here and equals to, cool, equals to, and you go up, click on the equipment right there, enter. Now we have equipment. Now, how much cash do we have? So in order to see how much cash we have, we can go here, draw a line. So we can say, okay, whatever is on the debit side, like that box, right? So here we say equal to that box plus that plus this plus that plus that plus that minus this minus the other box minus the other box minus the other box minus the other box minus the other box. Make sense? So all the debit sides, add them up, minus all the credit sides, whatever it is, enter. So as you see now, we have $87,000 cash available. So if you are a bookkeeper and I ask you how much cash do we have right now, you say what? You say, let me look at it. So you look at the general ledger, right? General ledger. You look at the cash T account, cash register for the cash here, cash T account, and you tell me we have $87,000 right now. Cool. Okay. Any question for me? Anyone? No? Okay. You see how many times I'm asking? And here says, question says, what happened to capital? Why capital stays 100? Capital stays 100 because that's your initial investment into the business. You don't pay for equipment with your capital. Can you go to a dealership and say, hey, I want a car and I have a business and my business has a lot of capital. They say, okay, good for you, but where is your cash? Nobody cares about your capital. Everyone wants what? Cash. So that's how you buy a car or equipment or anything else. So wasn't capital $100,000 because we put $100,000 cash though? Yes. So your capital has been increased. So now because of that capital, now you have $100,000 cash in here. Now, anything you want to do, buy something or sell something, either your cash will increase or your cash will decrease. Make sense? Your capital is still the same thing. Your capital is still the same thing, maybe many years later, still same thing. Capital is the same thing, it's not going to change. Of course, your capital normally as a sole proprietorship will change. Why? Because here, you see that equity will change because your owner's capital is 100,000. Then you withdraw, let's say for emergency personal reason, you withdraw $5,000 from your checking account for personal reason. This is sole proprietorship I'm talking about, okay, not the corporation. In corporation, you cannot withdraw. There is no such a thing as a withdrawal. In corporation, we have dividend, which board of directors will declare dividend every quarter or every year. But for sole proprietorship, you can pick up money, take money out of your account anytime you like. So you take a withdraw, and that $5,000 withdrawal, technically at this moment, push your owner's capital to 95. Okay? Let's say you want to go to Hawaii. You take $5,000 and your owner's capital becomes what? 100 minus 5 withdraw. The result will be 95. The result will be 95, okay? And then, of course, if you make money and you create net income, guess what? The net income will increase your owner's capital down the road. You will see later on. So only thing is changing here is cash. Cash is changing, not owner's capital. Owner's capital is the same thing. At this momentarily, till end of the year. At the end of the year, owner's capital will get updated. It might go up, it might go down, depends on the situation. For now, the third one says paid utility bill for $10,000. Okay, $10,000. Okay, so what do? You say, okay, let's pay. First of all, if I pay something, cash goes out of my pocket, far away, right? So let me do that one. So let me go to the second line, because that's easy one for me. So I say indent, and cash goes out of my pocket, $10,000. So equals to $10,000. This one will be equals to $10,000 here. But what is it? Why did I pay $10,000? Let's read it again. It says paid total utility bill for $10,000. You see that? Okay, so that means you don't call it utility bill, you call it utility expense. So you call it expense. Here we go. You used electricity or water or whatever, utility expense. That's what you call it, utility expense. Something that it's common, everyone can understand. You get a bill, but you call it expense. Make sense? Some student put it here, utility bill. No, utility bill is the name of the bill you received. The name of whatever happens is utility expense happened. That's what happened. So you call it utility expense. And if you want to show it in here, it's very easy. So you call it equals to minus cash goes out of your checking account, obviously. So it's a so-called negative. And here, expense equals to minus, you see expense has a minus. You see that right there? I'm just reflecting that. And that will be the expense. So expense will increase. Expense will increase. And cash will, expense increase, but it will have a negative effect on your what? On your equity. Has a negative effect on your equity. And cash is also decreasing, so that has negative effect on your asset. So your asset is going down, expense is increasing, that means equity is going down. Expense is increasing, that means equity going down. So as you see on both sides of the equation, still I am equal. 90 here, 90 here. And don't forget, you need to click save, right? So click save, so-called, and imagine if it's a QuickBooks, and you save it. Into what? Into general ledger. That's where you save it. See? Okay. Let's do it. So cash goes out of pocket. So equals to that credit. Enter. Agree? And utility expense. Account number starts with 5, something like that. So let's look at the worksheet. I mean 6. 5 is for cost of goods sold. 633. So 633. 633. There you go. And that's a debit. Equals to. And then click on the box which says 10,000. Enter. And as you see, now my cash is updated. How much cash do I have? $77,000. And how much utility expense I have? $10,000. How much capital do I have? 100,000. How much equipment? 13,000. So if I ask you any moment, how much do you have in any of this account? You go to general ledger and you look at the balances and you tell me right away. Same thing in QuickBooks. You go to general ledger, look at the T account, tell me how much you have in each account. That's what you do as a bookkeeper, okay? We are doing bookkeeping right now. Do you enjoy it? Welcome. Okay. By doing this, I would like to learn some stuff. So let's see if we can learn it. What is, look at this cash. Is cash an asset? Huh? Yes? Okay. What's the normal balance on any asset? Is it on the debit side or on the credit side? Normal balance. As you see, normal balance for any asset like cash is on the debit side. Let's look at the equipment. What's the normal balance for any asset? Debit side. Asset, debit side. Asset, debit. Asset, debit. Asset, debit. Normal balance for any asset, debit. Asset, debit. You see how many times I'm repeating? Okay, so you imagine how many times you have to repeat. Okay, owner's capital. What's the normal balance for owner's capital? So if I tell you, draw me a T account and show me owner's capital for $100,000, which side do you put it? On the credit side. Owner's capital, credit. Owner's capital, credit. Owner's capital, credit. Owner's capital, credit. So if I tell you draw a T account, write owner's capital, $100,000, show me the T account, and you put this 100,000 on the debit side, shame on you.
No, they're back.
So owner's capital, it's a normal balance of credit. Are we good?
Yeah.
Okay, I'm gonna mute everyone so I don't have extra voices here, but in case you want to respond to something, please unmute and then mute it again yourself, okay? So I don't have extra background noises. Okay, so let's do the same thing for expense. As you see, normal balance for any expense is debit, expense, debit, expense, debit. That means if you do debit on expense, expense will increase. If you do debit on any expense, expense will increase. Expense, debit. If you do any credit on the owner's capital, the capital will increase. If you do any debit on the cash or any asset, that asset will increase. If you debit on the equipment, equipment will increase. Normal balance for any asset, debit. So let's go up. Okay, let's go up here. Let's put it in here. So normal balance for any asset. Normal balance for any asset, debit. Normal balance for any asset, debit. For liability, it's a credit. For owner's capital, credit. For withdraw, debit. For revenue, credit. For expense, debit. Expense, just like withdraw, you are taking money out of checking account, right? Make sense? So that's a debit, debit. Owner's capital, you put money into business, right? Remember, owner's capital, you put money in the business. So it's a credit, just like revenue. You have revenue, you put money into business. So that's a credit too, okay? And for liability, it's a credit also. Why? Because you borrow money, you put money into business, that's a credit also. Okay, this part that I'm saying you why is just stupid explanation, but I'm just trying to make it like common sense that you can remember it. Otherwise, the hard answer is you have to memorize it no matter what. So I'm just trying to make it like common sense. Okay, so if you get asset, right? Asset, you put asset into your business, it's a debit. Remember like that, asset, debit, asset, debit. Liability, credit, liability, credit. Equity, credit. Withdraw, debit. Revenue, credit, expense, debit. In a matter of a week or two, you have to get used to this. Okay, so let's keep going, one more. Ready for another one? So guess what's going on right now? Number 4. Number 4 says, you paid in advance rent for the whole year. My goodness, 24,000. So it looks like your credit history of the corporation, or I mean the business, is not good. So the landlord is asking you to pay 1 year in advance. Let's talk about this part. This is about cash method of accounting or accrual method of accounting. We have 2 methods of accounting: cash method, or accrual method. Okay, cash method or accrual method. In the cash method of accounting, you record expense when you pay for it. You record revenue when you receive cash. So in the cash method of accounting, you have to declare on your day 1 when you open a business, You have to say, I'm going to do cash method or accrual method. IRS wants to know that when you file your taxes. So you do cash method. If you are a small business, you can do cash method, no problem. And you, as soon as you pay money to someone, it becomes expense. As soon as you receive cash, becomes revenue. Now, in regards to accrual method, it's different. Accrual method says you record revenue when you earn it, not when you receive cash, but you earn it. That means when the job is completed, the performance obligation is satisfied. And at that moment, you can record revenue under accrual method. And also under accrual method, you can record expense when you got the benefit out of the service or item that you received, and you have obligation to pay for it. Doesn't matter when you pay it, as soon as you get the benefit and you get obligated to pay for it, at that moment you record your expense. You might pay 2 months later, doesn't matter, but you record it today. And the accrual method is providing much better so-called picture of your activity, okay? I give you an example. Let's say I go outside of my home at 7 a.m. My wife says, where are you going? I said, I'm going, working. And imagine I am cash method of accounting, right? So I go, I work the whole day. I wash cars for many clients. I come back in the evening and I send invoice to all those clients that I washed their car today. Okay, I washed, let's say, 10 cars, $20 each. So 10 times 20 is $200, right? I send them invoice through email. Perfect. And my wife said, okay, what did you do? What did you do today? I said, I worked hard all day long, and and she said, okay, how much did you make? And because I'm cash method of accounting, did I receive anything? No, under cash method of accounting, if you didn't receive anything, there's no income. You have to wait till you receive cash, right? So my wife says, okay, how much is your income for today? And I say 0. Then she says, wait a moment, where have you been again? Right? She gets suspicious because my revenue shows 0. Swear to God, I was working the whole day, but this cash method of accounting is preventing me from recognizing $200 of revenue because I didn't receive anything yet. So it's not cash method is not providing a good picture of your actual activities, right? And imagine I have another friend that he wants to become a partner with me, and he said, okay, how much did you work today? Show me your income statement. And I say, my revenue is 0. Even investors, they get suspicious. They say, what type of business is this? Making no money. But in order to do a good picture of whatever you are doing for big businesses, you have to do accrual method. Publicly traded companies, definitely accrual method. Cash method is not accepted under GAAP. GAAP says cash method maybe is good for the IRS, filing a small business tax return, but for a big corporation, big type of companies, accrual method, that's what is recommended, that's what is accepted. So under accrual method, if it was my business accrual method of accounting, so if my wife says, what did you do today? I said, okay, I have generated $200 of revenue, and here is the income statement. I can print the income statement, and I can show that revenue has been recognized. Okay, so now let's go back to this idea of paying, where is it? The advance rent. So I paid advance rent to the landlord for the whole year, $24,000. We are doing always accrual method of accounting, okay? Cash method is very easy, so we are doing accrual. That's what we are learning. So under accrual method of accounting, did I get any benefit out of this property yet? No. I just paid in advance so I can move in. So that will be, the journal entry will be obviously easy. I go to the second line first because credit is the second line. So cash, $24,000 will be credited. Therefore, something will be debited. And one more time, why did I spend $24,000? Let's go back. You see how I'm doing it to just make sure I don't make a mistake? So I start with something that I know 100% cash goes out of my pocket, credit far away. The other one has no choice, has to be debit no matter what. All I need is a name. Okay, what name? Why did I pay this? Paid in advance rent. Okay, so I call it what? Do I call it rent expense? No, because this is accrual method of accounting. So under accrual method of accounting, I only recognize expense when I get benefit out of it and I have the obligation to pay for it. But here I didn't get any benefit yet, so it will be asset, prepaid rent. That's what it is. So what would be the accounting equation thing? The accounting equation thing, it will be equals to minus cash, right? Minus cash. You see that? Cash is gone. However, equals to prepaid rent is an asset, that asset received. So as you see, here we go. Nothing is changing. Both sides are equal in the accounting equation. Life is good. Don't forget to post it. So click save here. Imagine it's a QuickBooks. So click save and post it, which you have to do it manually. So let's do it. So go to general ledger and post it to the general ledger and save it in the general ledger. So cash goes out of my pocket, obviously, equals to, go back, click on that box and click enter. I mean, push enter, okay? And my cash goes down, 53. But I got prepaid rent. Prepaid rent. What's the account number? Let's use worksheet. Prepaid rent here, 128. Let's use that, okay? 128. I'm just using that same number so I can kind of relate to the same thing. 128, enter, voila. And asset will be equals to prepaid rent, debit side, asset equals to, all the way up, right there, enter. As you see, if you ask me right now how much money you have in each account, I can tell you, no problem. I can tell you that I have $53,000 cash in my cash T account. I have owner's capital, 100,000, equipment 13,000, utility expense 10,000, prepaid rent 24. Can you tell the same information from journal entries? No. Journal entries That's what you record. And you do hundreds of those. So you don't know exactly what you have unless you go where? Unless you go to general ledger. So general ledger is where you get smart. You know what's going on. Everything is prepared from general ledger. So if I want to prepare any balance sheet or anything, that's where the information is. Any question for me? Anyone? Nothing? Easy? Yeah. Okay. Let's do one more since it's easy. And let's do 5. Received prepayment revenue during the year, $45,000. God bless America. So you receive $45,000 from a client as a prepayment to do a job, whatever it might be, later on. I like that. So here we go. Cash goes in my pocket, close to me in my pocket. Closest place is debit. So let's do that. So cash in a QuickBooks, again, I said, you see where the cross is right now? There is a box over there. You click on that, the drop down menu will open, you chart of account, look for the account that you like, let's say cash, click on that, voila, cash will pop up. Here I have to type it, but in QuickBooks it's much easier. Okay, so how much? Equals to that much. $45,000 received, debit. How much is the credit then? Same thing, right? Enter, 45. But what? Okay, what happened? I got prepayment. Did I earn it? No, because I'm doing accrual method. And under accrual method of accounting, right? Under accrual method of accounting, we recognize revenue when job is complete, performance obligation is satisfied. At that moment, I can recognize revenue. Let's say you are making a 5-story building, $5 million contract. You finished at the end of first year, you finished 20% of that building. Based on percentage of completion, you will recognize at the end of the year 20% of 5 million, that is 1 million. So you will recognize $1 million of revenue. Doesn't matter you received that $1 million or not. It will become accounts receivable, but you recognize that. Make sense? Percentage of completion for contractors. Okay, so here we go. Cash, $45,000 received, something has to be credited, but I did not earn this yet. I did not earn it. I cannot recognize as a revenue. So I call it indent on earned revenue. There you go. Unearned revenue. So what's going to happen in the accounting equation? Here, what is going to happen? Here you received equals to $45,000 cash, and in the liability equals to $45,000 liability on earned revenue. You can call it also deferred revenue. That means you defer the recognition of revenue. Deferred revenue or unearned revenue. Okay? So liability goes up, asset goes up. So if you add up this part, it will be 135. 100 plus 45 minus 10. Okay? And This is done. Don't forget to post it. Click save, right? Of course, there is no click save here. This is an Excel, so you need to remember to post it. So let's post it. So here we go. Post it in where? Post it in general ledger. So equals to, go up, click on cash, enter. And then do you see anything here says revenue? Huh? No, no problem. Create one. Here we go. Revenue. Account number, what? Account number what? Let's see. Go to worksheet, revenue, account number is, we used here, fees earned. You see fees earned is same as revenue, 401. Fees earned. Why did I write fees earned? Because I want you to see it. Because I want you to understand revenue or fees earned, same thing. Sales revenue, same thing. Commission revenue, same thing. Contract revenue, same thing. Bookkeeping revenue, same thing. 401. Of course, if you have many other type of revenues, you create different revenues. Let's say you have fees earned dash consultation. Then you have fees earned dash bookkeeping. Fees earned dash audit. Fees earned dash accounting. All those will have a different account number, 401, 402, 403, 405, make sense? So you will have different account numbers. Unearned revenue is 2013, yes. So, sorry, thank you. So now let's go. Are we recognizing revenue? No, because it's not earned yet. So we need something different. We need unearned revenue, right? So even though revenue is 400, but we don't need it. Thank you for reminding me. So here is unearned revenue, 213. Why it starts with 2? Because it's a liability. So let's use that number, 213. Let's go back. So this is not a revenue, right? Watch. This is not a revenue. This is unearned revenue. So I need to change this. So I'm going to leave this revenue here for now, since I did it already. So here I call it unearned revenue, just like that. There's not that much room. Number, I forgot. What was that? 213. Where is it? Tired. Unearned revenue, 213. Okay, let's go. 213, 213. Enter. Okay, unearned revenue is a liability. Normal balance for any liability is credit. Liability, credit, liability, credit. Go to the credit side. You see equals to, and as you see, here should be credit too. There you go, it's credit. Enter. Done. Okay. Questions? Okay. So what happened? This is what happened. We put some deposit in the cash. We bought equipment. We paid for utility. We paid for prepaid rent, and we got some cash for unearned revenue. Now, let's look at this. On December 31st, unearned revenue balance was 2,000. That's a good information we needed. Line 13, that's a good information. But we need it at the end of the year, December 31st. For now, let's finish. Keep that in mind because that comes handy later on when we want to do adjustment and recognize a proper amount of revenue. But for now, there's something that I really need to do the journal entry. In the middle of the year, during the year or whatever, total $12,000 has been taken out of checking account by the owner. Okay, for personal reasons, personal expenses, whatever. So $12,000 has been taken out. So let's go. Let's go here. I can do the easy one here. Easy one is this. Cash goes out of the pocket, right? Far away. So here we go. Cash goes out of pocket, far away. Equals to that much, 12,000. And the other one will be equals to that box. Enter. Cool. And now here you have withdraw. That's what you call it. Withdraw. If it's two owners, like a partnership, you will say withdraw dash Robert, withdraw dash Joseph. But if it's just one owner, who cares? Then just call it withdraw. Make sense? Because you have to keep record of who put how much capital in and who took how much money as a withdrawal. But in this case, it's just one owner, so there is not a big deal. So that looks like in here as this. Withdraw is equals to minus that number, 12,000. And here, you see withdraw has a negative impact. Do you see that negative impact? So here we say, I say equals to minus that box. So here we go. So now, as you see, my asset part is 123 and my liability plus equity is 123 also. So I am equal on my equation. I didn't break any balance or anything. I am good to go. I'm doing accrual method anyway, and I'm gonna click save in here and post it to the T account. So let's post it. So here is cash equals to, go up, click that box, enter. So I have $86,000 cash at the end. And I need something says withdraw. So here is withdraw. Withdraw. And what's the account number for withdraw? Account number for withdraw is withdraw 302. I'm going to use that. Okay, 302. So here we go. Withdraw 302 starts with 3 anyway. So here we go. Debit, normal balance for withdraw, debit, withdraw dividend, same thing, debit, equals to, I go up, 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 up. Here we go, withdraw $12,000, enter. So now I have all these T accounts with balances, 45, 12. There is no revenue yet, but there's a prepaid rent. There's utility expense, equipment, cash, owner's capital, right? All those type of things. Huh? Beautiful. So what you do at this moment, this is end of the year now. You have to see what's going on. So you have to put your account numbers in the trial balance, create this trial balance. Okay, so what do we have? We have cash. How much? Equals to, and here, how much? 86,000. Huh? Enter. So the trial balance. I need also a room here for a date, but I didn't create one, so I just put the date here momentarily. Okay, that's 12/31 2014, okay? But it should be under each other, but I use this way. So here we go. Next one, after cash. What is the most liquid after cash? Let's watch. After cash, the most liquid asset is prepaid rent. That's it. Okay, so prepaid rent. Let's go. So after cash, prepaid rent. And that's equal to $24. And I believe that's it. Equipment is the next. Equipment. Okay, how much equipment I have? Equipment that I have is, here we go, 13,000. Oh, I forgot to say equals to. Yes. Okay, equals to. And then here, equal to that box, enter. Okay, any more asset? I don't think so, do I? No. Okay, the next one after asset is what? After asset is liability, right? Unearned revenue. Normal balance for unearned revenue liability is credit side, liability, credit side. So I go on the credit side, I say equals to, then go down, find your, here, unearned revenue, 45,000. Cool. There you go. Any more liabilities? Any more liabilities? No. Okay, after liabilities is what? Capital. So owner's capital, and that's a credit side equals to normal balance capital, credit side, and equals to that box. Enter. And after capital is what? Withdraw. So here we go. Withdraw. And withdraw is a debit side, right? Withdraw debit equals to debit. That box, enter. Yeah, after withdraw, we have revenue. There is no revenue. Okay, how about expense here? So let's put expense. What expense was that? Utility. Utility expense. And expense normal balance is debit equals to, let's go to the T account, you will see. Expense is on the debit side. You see that? Enter. Okay. So now see what's going on now here. Let's do this. Sum. Here. Enter. 145. Go here. You see that fill handle? Huh? Grab it with your mouse, click, push it to the right, let it go. And that will be 145. Life is good. Voila. Congratulations. So we did so far so good, right? So what we did during the year, we did all the transactions that happened. Hundreds and hundreds of transactions. Here we did few just to get the idea, but hundreds and hundreds of transactions. You record them, you post them to the general ledger T accounts. Then at the end of the year, you create your trial balance to see what's going on, what do you have, how much you have and to decide what needs to be adjusted. In order to see what needs to be adjusted, because there are so many adjustment possibly. So what you do, you go to the worksheet and you transfer all those information into here. You see the worksheet? You transfer all the information into here. So I have the solution already here. I transferred all the information into here. As you see, cash, prepaid rent, equipment, unearned revenue. This is the trial balance that I was just preparing. And the year is 145, 145. Don't worry about this part yet, but you need to practice. Whatever I did today, you need to do it on paper, maybe 2, 3, 4 times. You need to do it on Excel, maybe 2, 3, 4 times. So I gave you the Excel and your job is to practice. I cannot practice it for you. So don't think I am a magician or something. Okay? Any question for me?
Excuse me, Professor, I have a question.
Mm-hmm.
In number 2, we had, I think, 1,000 residual. We didn't do anything about that. And about number 6 too, we had 2,000 unearned revenue balance. We didn't do anything for that too, doesn't it?
Yes, you have to do adjustment on that. But what was number 2 you said? Number 2 what?
We had 1,000
Residual value. Yes. Those 10 years life and residual value, those are estimation that you do as a bookkeeper, and you use these estimation numbers at the end of the year to do adjustment for depreciation. We are not there yet. We just want to know, as of December 31st of 2014, what do we have before adjustment here? You see, after adjustment is here. You see that? This is after adjustment, it's blank yet. So before adjustment is here. Before we do anything about this $1,000 and accumulated depreciation things, this is what we have. Before we think about how much revenue has been earned, this is what we have. But at the end of the year, a bookkeeper and accountant needs to think. They have to think, okay, this is what we have, but is this enough? Is there anything that needs to be recognized? I give you an example. Every year, there's one day in a year that you go and buy a cake. Why do you buy a cake? Because you want to recognize that 12 months has been passed and you are older and you need to recognize it. So what you do, you buy a cake, you invite your friends and family, and everyone take a picture, blow candles and eat cake and fruit and happy day. You make it happy day. It's not a happy day, it's just confirmation of you getting older one day, 1 year. So that's the adjustments that you do by buying a cake and blowing candles. Same thing in a business. At the end of the year, we need some adjustments, but there is not time today to do that. So for you, it's right now time just to practice whatever we did and keep number 6 in mind and keep this 10 years in mind, keep $1,000 residual value in mind till we figure out what to do with those.